We're looking at a 7-cent stock with a brutal chart and asking if it's a bargain or a warning sign. Today we're looking at a stock that tells a tough story, one of a steady slide in price. Even though the underlying business, on the surface, seems to have real assets, it forces us to ask a hard question. When is a low price a bargain, and when is it a warning sign? The company is ESE Entertainment, ticker ESE, and it's currently trading at about 7.5 cents per share. Just a few months ago it was sitting near its yearly high of around 17 cents. So what's behind this consistent downward pressure? And could there still be a value opportunity hiding under an ugly chart? Let's break it down. Quick reminder, I'm not your financial advisor. This video is for educational and informational purposes only, and is not financial advice. Penny stocks and small caps are very risky and you can lose all your money. So always do your own research or talk to a licensed professional. Before we talk about the stock, we need to talk about the business, because this isn't just an idea on a slide deck. ESE's main engine is Digital Motorsports. This isn't just an esports team. It's a major European e-commerce platform, selling high-end sim racing hardware. They sell real, physical products from steering wheels and pedals to full racing cockpits, and they've been generating meaningful revenue from that activity. That's the core of the bull argument, a company with real, tangible sales in a passionate niche. This isn't a pre-revenue startup, living only on promises. On top of Digital Motorsports, they still have their legacy esports and event production arms. The original plan was to build an ecosystem around digital racing hardware, leagues, media, and community, and that's still the strategy management talks about. So what's the bull case for a stock that's been cut in half? It's basically a deep value thesis. The idea is that the market has punished the stock too aggressively, and that today's tiny market cap doesn't reflect the real value of those revenue-generating assets, especially the Digital Motorsports business. If you're bullish, you're betting that ESE can stabilize operations, get its cash burn under control, and convince the market it's a sustainable business. If they manage that and simply work back to the recent high around 17 cents, that would be more than a 100% move from here. The upside case is a turnaround story and a belief that sentiment has swung too far into pessimism. Now let's talk about why the stock has been sliding. Because the bear case is loud. The market's primary concern is profitability and cash burn. Even with growing revenues, ESE has not yet turned a profit. A company that keeps losing money is a serious red flag, especially in a tougher economy where investors are less patient with maybe someday stories. That ongoing decline in the share price reflects a growing fear that the company won't reach profitability before it needs fresh capital. And that leads straight into the second big risk: dilution. At a 7.5 cent share price, raising any meaningful amount of cash would likely mean issuing a huge number of new shares. That would severely dilute existing shareholders, and the market can see that math. This isn't a sudden crash on one piece of terrible news. It's a long, grinding downtrend that signals a chronic lack of confidence. In many ways, that slow bleed can be more dangerous than a sharp panic, because it shows that investors, over time, are quietly voting no with their money. So where does that leave potential investors? The story of ESE Entertainment is a classic clash between value and momentum. Bulls see a revenue-generating business, selling for far less than they believe it's worth. Bears see a history of losses, looming dilution, and a chart that screams market doesn't believe. An investment here is absolutely not for the faint of heart. This is a high-conviction, speculative bet that management can pull off a turnaround before the balance sheet forces their hand. If they succeed, the reward from these levels could be significant. If they fail, the downside could be brutal. Do you see a hidden gem that's been thrown in the bargain bin, or a textbook value trap that looks cheap for very good reasons? Let me know your take in the comments. If you found this breakdown helpful, tap like, subscribe to Penny Stock Pulse for more research-driven penny stock deep dives. And ring the notification bell so you don't miss the next one. Thanks for watching, and I'll see you in the next video.